guys, I'm the investment venturer, and welcome back to the Investor Next Door podcast. Today we'll be discussing how to navigate a potential recession and some recent market news. I should let you guys know that anything said on this podcast should be used for information and entertainment purposes only. This is not investment advice, and I do not recommend diving into any project or trying any strategy without doing your own research first. Let's start by defining what is a recession. A recession is a business cycle contraction that occurs when there is a period of broad decline in economic activity. Recessions generally occur when there is a widespread drop in spending. Understanding recessions. Since the Industrial Revolution, most economies have grown steadily, with few economic contractions. However, recessions are still common. Between 1960 and 2007, there were 122 recessions affecting 21 advanced economies, according to the International Monetary Fund, IMF. In recent years, recessions have become less frequent and shorter in duration. Declines in economic output and employment that recessions cause can become self-perpetuating. For example, declining consumer demand can prompt companies to lay off staff, which affects consumer spending power and can further weaken consumer demand. Recessions are most clearly identified after they are over. Additionally, investors, economists, and employees may have very different experiences in terms of when a recession is at its worst. Equities markets often decline before an economic downturn, so investors may assume a recession has begun as investment losses accumulate and corporate earnings decline, even if other measures of recession remain healthy, such as consumer spending and unemployment. Conversely, since unemployment often remains high long after the economy hits bottom, workers may perceive a recession as continuing for months or even years after economic activity recovers. What predicts a recession? While there is no single surefire predictor of a recession, an inverted yield curve has preceded each of the 10 U.S. recessions since 1955. That being said, not every period of inverted yield curve was followed by a recession. What causes recessions? Numerous economic theories attempt to explain how and why an economy goes into recession. These theories can be broadly categorized as economic, financial, psychological, or a combination of these factors. Some economists focus on economic changes, including structural shifts in industries, as most important. For example, a sharp sustained surge in oil prices can raise costs across the economy, leading to recession. Some theories say financial factors cause recessions. These theories focus on credit growth and the accumulation of financial risks during good economic times, the contraction of credit and money supply when recession starts, or both. Monetarism, which says recessions are caused by insufficient growth in the money supply, is an example of this type of theory. Recent recessions. The COVID-19 pandemic is an example of an economic shock that can cause a recession. The depth and widespread nature of the economic downturn caused by the COVID-19 pandemic in 2020 led the NBER to designate it a recession. In 2022, many economic analysts debated whether the U.S. economy was in recession or not, given conflicting economic indicators. Analysts with investment advisory firm Raymond James argued in an October 2022 report that the U.S. economy was not in recession, despite the fact that the economy met the technical definition of recession after 2 consecutive quarters of negative growth. Numerous other positive economic indicators showed that the economy was not in recession, the report argued. It cited the fact that employment continued to increase even as GDP contracted. The report further pointed out that although real personal disposable income declined in 2022, much of the decline was a result of the end of the COVID-19 relief stimulus, and that personal income excluding these payments continued to rise. Now that we understand recessions a bit more, let's now jump into what you should do as an investor to protect yourself and your wealth if a recession were to hit. 1. Strengthen your financial foundation. Emergency fund. Aim for 3 to 6 months of essential expenses in a high-interest savings account. If you're unsure about your job security, are closer to 6+ months. Budget tightening. Cut non-essentials now so you're lean if income drops. Focus on needs greater than wants and look for recurring expenses to eliminate or reduce. 2. Secure your income. Job stability. Evaluate your industry and position. Is it recession-proof? Consider upskilling, freelancing, or building a side income stream. Avoid job hopping unless strategic. During downturns, being the newest hire can make you more vulnerable. 3. Be strategic with debt. High-interest debt equals enemy number 1. Pay off or consolidate credit card debt and any other high-interest loans. Fixed greater than variable. If you have variable interest debt, for example, mortgages or lines of credit, consider locking in a fixed rate if you expect rates to stay high. 4. Invest smart, don't panic. Stay the course. If you're investing for the long term, for example, retirement, don't sell in a panic. Dollar cost averaging through a downturn can be a wealth-building move. Recession-resilient stocks. Think consumer staples, utilities, healthcare, and dividend-paying companies. Avoid highly leveraged, speculative, or cyclical stocks unless you know the risks. Keep cash ready. Having cash on hand lets you buy the dip when opportunities arise. Think of it as dry powder. 5. Watch for deals. Recessions often bring lower prices on assets, stocks, real estate, and businesses. If you're financially stable, you might find great opportunities to invest long-term. 6. Think holistically. Mental and physical health are part of financial resilience. Keep perspective. Recessions are temporary. The goal is to protect now and position yourself for growth later. Now that we've understood how to navigate a recession, I hope you're able to use these tools to protect and accumulate wealth in 2025. Now let's discuss some recent financial news. This podcast is in no way diving into geopolitical issues, but these issues tend to affect the stock market and therefore directly affects us as investors. President Donald Trump again called on Jerome Powell to cut interest rates after threatening to oust the Federal Reserve Chairman. The president pointed to how Europe has already lowered rates 7 times and that Powell has always been too late. The president also downplayed concerns about inflation, saying energy costs and food prices are down. He also said that there is virtually no inflation, but as we can clearly see, inflation is definitely still present. The comments are the latest in an escalation of attacks on Jerome Powell after the policymakers said that the president's tariffs would lead to higher inflation and lower growth, and that the Fed would hold rates steady for now. Since the beginning of 2025, global financial markets have been turned upside down by President Donald Trump's burgeoning trade war. Markets are not in full panic, but the double-digit declines in major U.S. stock indexes are testing nerves. The U.S. market had been on a 2-year tear coming into 2025, though many believed that stock prices had become overinflated. Trump's trade war pushed that sentiment into hyperdrive. The S&P 500 has tumbled 13%, and U.S. markets are being outpaced in Europe, Asia, and just about everywhere else. Trading in traditional safe havens like U.S. Treasuries and the dollar has become erratic and unpredictable. The U.S. dollar struck a 3-year low, and U.S. Treasury yields have been soaring. Typically, yields would fall as investors seek a safe place to park their money. U.S. Treasuries no longer appear to provide the shelter they once did. Only gold, a commodity traded internationally, has maintained its reputation as a safe zone. The price of gold is hitting one record high after another. As discussed earlier in this episode, this may be a good time to watch for deals on the stock market. If you have some cash ready to deploy, you may be able to find opportunities for great long-term investments. Thank you guys for listening to my podcast. Be sure to subscribe to the Investor Next Door podcast on your favorite podcast listener. If you're watching on YouTube, be sure to like and subscribe for future episodes. Follow me on social media to stay updated. Twitter X @InvestNDPod, Instagram @InvestNDPod. Share this episode with your friends if you've learned something valuable from this podcast, and I'll see you guys next time.